Have you ever wondered what happens when widespread optimism turns into excessive risk in financial markets? Imagine a time when investors could borrow heavily to chase rising stock prices, multiplying both their potential gains and their hidden dangers. In 1929, margin buying significantly fueled market instability by allowing investors to purchase stocks with borrowed money, amplifying both market gains and subsequent losses. This practice created an artificial demand that made the eventual crash more severe, as even a small decline in stock values could wipe out an investor's entire equity, forcing widespread selling and accelerating the market's collapse. The core mechanism was quite simple, yet profoundly risky. Investors would put down only a small percentage of a stock's price, often as little as 10 to 20%, borrowing the rest from their broker. This borrowed money was secured by the very stocks they were buying. As long as stock prices rose, investors reaped outsized profits on their relatively small initial investment, encouraging more people to join the speculative frenzy. This created a positive feedback loop, where rising prices encouraged more margin buying, which in turn pushed prices even higher, detached from underlying company fundamentals. The crucial vulnerability emerged when prices began to fall. Brokers would issue a margin call, demanding that investors deposit more cash or sell their holdings to cover the loan. Many investors, lacking additional funds, were forced to sell, flooding the market with sell orders, which further depressed prices and triggered more margin calls, leading to a catastrophic downward spiral. Understanding this historical dynamic offers a vital lesson in financial prudence and market behavior. It illustrates how excessive leverage, when combined with speculative fervor, can transform routine market corrections into severe economic contractions. This knowledge helps us appreciate the importance of regulations designed to curb speculative excesses and protect the stability of financial systems. Recognizing these patterns allows us to better identify when market enthusiasm might be outstripping economic reality. A key component of this period was the prevalence of brokers' call loans, which are loans made by banks and corporations to brokers, who then reloan this money to margin buyers. By late 1929, these call loans totaled more than $8 billion, a staggering amount for the time. This vast pool of easily accessible credit directly supported the escalating margin purchases, making it a critical, albeit often overlooked, factor in the market's over-leveraged state. These loans were callable, meaning they could be demanded back by the lender at any time, adding another layer of fragility to the system. Ultimately, the story of margin buying in 1929 teaches us that seemingly easy paths to wealth can conceal immense systemic risks. By appreciating how leverage magnified both gains and catastrophic losses, we gain a deeper understanding of market bubbles and crashes, reinforcing the need for cautious financial practices and robust regulatory frameworks to safeguard economic stability.